Welcome to This Explainer. Today, we're unpacking a pretty provocative macroeconomic thesis from Alasdair Macleod regarding a massive structural divergence happening right now between Eastern and Western economies. Now, you might be wondering, why does this matter to us? Well, because the very foundation of your purchasing power might literally be shifting beneath your feet. Let's break down exactly what the source material argues is happening behind the scenes of global macroeconomics. Let's jump right in with a rather stark warning straight from Macleod's analysis. He points to an impending and perhaps completely unavoidable shift away from global fiat currencies. The thesis argues that, short-term market trading and those daily price fluctuations, they're actually secondary issues right now. The real story, the absolute imperative, is the need to escape the global credit ecosystem entirely before it breaks down. To see how the analysis reaches this alarming conclusion, here is our roadmap for today. 1. The global debt trap. 2. The gold-backed Eastern strategy. 3. The burden of Western welfare. 4. Lessons from the 19th century. And finally, 5. The ultimate economic weapon. All right, starting with Section 1, the global debt trap. The source material points out that major Western powers are literally staggering under massive structural debt loads that now surpass 100% of their GDP. It's a staggering figure. The G7 nations, including the US and the UK, are running these huge systemic deficits simply because of political imperatives to keep spending. As the analysis notes, governments have basically been conditioned to think they can just flip a switch, print more currency, and poof, pay their bills indefinitely. And that's just driving this ratio higher and higher. Now, brace yourselves for some serious visual whiplash here. According to the analysis, despite widespread perceptions of terminal economic isolation, Russia's government debt to GDP ratio sits at a remarkably robust 20%. The thesis highlights this as absolute dream stuff for Western economies, showcasing a fiscal balance sheet that is incredibly flexible, especially when you compare it to the heavy, heavy debt burdens of the G7. So, the crucial takeaway here is that Western nations are caught in a classic debt trap. But what does that actually mean? Well, a debt trap kicks in the exact moment an economy stops growing, and the government can't cover its interest payments, not even notionally. At that point, investors understandably demand higher yields to lend their money. But as sovereign yields rise to outpace economic growth, the math just gets worse, making foreigners even less likely to lend. It becomes this vicious, completely inescapable cycle. To really put this into perspective, the analysis draws a direct comparison to the global energy crisis of 1974. Back then, bond yields spiked dramatically, hitting 13% in Japan, with inflation soaring to 25% in the UK. But here's the catch. During the 1970s, debt to GDP ratios were only hovering around 35 to 45%. Today, like we said, average debt levels sit at well over 100%. The analysis argues that our current system simply cannot afford to see interest rates spike like they did in the 70s. The math would quite literally break the whole fiat system. Moving right along to Section 2, the gold-backed Eastern strategy. Macleod suggests China is systematically preparing a highly structured dual-track mechanism. Forget about some empty economic promise or a brand new untested BRICS currency. The source actually dismisses that as a total distraction. Instead, the real game plan involves making the international offshore yuan convertible to physical bullion. It works like this. First, underwriting international transactions with gold at a fixed rate set by the People's Bank of China. Second, utilizing highly secure vaults like the Shanghai Gold Exchange to inspire global confidence. And by doing this, Beijing completely sidesteps its own strict domestic exchange controls. It's a fascinating strategy. And it's not just China. The thesis claims Russia presents an equally compelling case for an asset-backed restructuring. Because they are unburdened by heavy taxation, enjoying flat personal income tax brackets of around 13 to 15%, and operating as a dominant global energy exporter, Russia has the fiscal latitude to anchor the ruble to gold. The source details this really interesting arbitrage mechanism. If Russia makes the ruble a credible gold substitute, investors globally would borrow gold at low lease rates, then deliver it to the Russian central bank in exchange for high-yielding rubles. This deliberate flow would naturally and systematically drive their domestic interest rates down to around 3 or 4%. Imagine achieving that without causing any inflation. That is exactly the goal here. Okay, Section 3, the burden of Western welfare. This side-by-side comparison really gets to the absolute core of the structural argument in this thesis.
The West is basically boxed into a fiat ecosystem dictated by massive, non-negotiable welfare obligations. Because governments simply don't have the tax revenue to cover these crippling entitlement pressures, central banks are forced into continual currency printing and artificially manipulating interest rates. In stark contrast, the East's proposed asset-backed ecosystem relies on sound money and low taxes. Since they lack these specific welfare burdens, their commercial banks can organically generate local liquidity through productive business lending, and that's what keeps their manufacturing prices incredibly competitive on a global scale.
Which brings us to Section 4, Lessons from the 19th Century. To prove that tying currency to a physical asset actually promotes massive economic growth, the analysis looks back at a historical blueprint, the 19th century British banking era. While on a strict gold standard, UK domestic credit successfully expanded 12-fold over roughly 30 years. But crucially, the amount of physical currency hardly increased at all. This resulted in zero inflation, and even mild deflation thanks to technological advancements. Credit naturally served as a flexible substitute for currency. However, after the 1844 Bank Charter Act, the Bank of England mismanaged the whole thing by artificially depressing interest rates. Because the currency was tied to gold, that yield difference created an arbitrage opportunity, and gold immediately drained away to France where rates were simply better. The analysis argues that modern Western central banking is making the exact same mistake today, relying on artificial interest rates to manage failing economies. And finally, Section 5, the ultimate economic weapon. So, if this analysis is hitting the nail on the head, and the fiat system, which is currently buckling under those 100% debt to GDP ratios and inescapable debt traps, is on an unavoidable slide toward a total breakdown, we really have to ask, how can wealth actually be preserved? Where do investors go? The thesis is absolutely relentless on this point. The real imperative is migrating entirely away from institutional liabilities. The answer isn't just jumping to a different fiat currency or hiding in a digital derivative. The answer is moving into money without counterparty risk. When the very top level of credit, which is the currency itself, becomes unstable, true wealth preservation requires stepping completely outside of the credit ecosystem altogether. To wrap up this explainer, the analysis suggests that in a world getting more volatile by the day, avoiding counterparty risk means returning to assets historically recognized under Roman law. We're talking physical gold as your absolute primary defense, with silver playing a strong supporting role. Furthermore, the source makes a fascinating point. In a geopolitical landscape that seems to be inching toward military escalation, implementing an unassailable, gold-backed financial architecture could act as the ultimate economic weapon. It could completely bypass the need for physical warfare by simply outlasting Western fiat vulnerabilities. It leaves us with a pretty provocative thought to ponder. Is the global economy already quietly arming itself for a post-fiat era? Thanks so much for tuning into this explainer, and we'll catch you next time.